Good morning, everybody. I hope you all had a good weekend and are now all looking forward to the week ahead. Going to be November this week, once again, as I've said. Can't believe how quick the year's going. So last week's market results. The Dow was up 0.1%. Now bear in mind the week before it was flat, exactly 0.0%. We've had a 0.1% move in the last 2 weeks. The Nasdaq was down 1.3%. Again, the FTSE, dead flat last week. We saw a movement of only down 0.3% on the week. The bundle of four was down minus 1.2%, which I'll talk about a little bit in a minute. The Nikkei was up 1.5%. Shanghai was up 0.4%. And the DAX in Germany, again, flat as a pancake, down just 0.1% for the week. On the currency side, we saw a little bit of an uplift in the euro against the US dollar from less than 109 up to 110. We saw that movement on Friday. We saw the euro gain strength against the US. The British pound, although still very, very cheap in my opinion, remained flat for the week at 122 against the US dollar. The Aussie dollar again remained pretty flat at 76 cents. And the Japanese yen continued to weaken slightly, which is what the Japanese want, from 104 to 105. So if we look at some of the stories out last week in the US, it's earnings time, and despite the markets appearing fairly flat as a whole, there were some movements within individual stocks. And I'm going to talk about this a bit in a minute, about the difference between passive investing and active investing. Amazon is a good example. Amazon missed its expectations on its earnings last week. Just to put it into perspective, the earnings this quarter were 52 cents per share. The same time last year, the earnings were 17 cents per share. So in my book, that's a company that's going in the right direction. But albeit the market expected better earnings than that, and therefore it came off 5.5%. That said, the stock is still up 29% for the last 12 months, with the fall that happened last week. Apple, again, Apple didn't quite make its earnings. And for the year, it's down 4.5% as a share. But at the same time, during the last quarter, they still sold 5.85 iPhones every second for the whole 90 days. So again, these are companies that are growth and whose products are still in demand. And although they may have had a slight negative impact on their share price in the short term, longer term, you can own these shares all day long. Which comes back to the sort of argument about how, when I speak to some of the clients, their argument is, we just buy the market when it's down and then we sell it when it's up. Trackers, what we call passive investors, rather than, buying fund managers and having someone manage your money for you with specific stocks. Now, that's a fair enough comment if you know how to diversify those passive investments, them ETFs. You still need to have somebody that's going to go in and say, okay, well, here's an oil ETF, here's a consumer staples ETF, here's one in India, and manage that basket for you. Okay, you may say, well, I'm British, so, I'm just going to buy a FTSE tracker, and then when the FTSE's low, I'm going to buy it, and when the FTSE's high, I'm going to sell it. But to give you an example, I was doing some number crunching on this recently, and if you look at TrustNet, which is one of the applications we use to compare fund managers. Out of 68 fund managers that are on there that own UK equity shares, only one of them over a 3-year period returned a worse return than the FTSE itself. In the last 3 years, a tracker on the FTSE would have made just over 4%. The average on managers over 3 years is 17.5%. When you look at one of my favourite managers out there, Lindsay Train, Nick Train, the 5-year performance in his UK equity fund was 113% versus the FTSE on 23%. So I think the proof's in the pudding there. You buy the brains. I mean, one of the major reasons that you see this better chance of making money with funds is because, of course, a lot of companies pay dividends, and you don't get the benefit of the dividend in the tracker. That said, a lot of people that, purport the idea of wanting trackers and wanting passive investments also say you don't have to pay fees. But if you've got a company that pays you a dividend of 3% and you're paying the manager 1.5%, you've still got 1.5% more in your pocket at the end of the day. So the Premiership football looks very, very interesting this year. 5 biggest clubs out there, 4 of them, if Chelsea win tonight, are going to be within a point of each other. The one team that's 7 points adrift, Manchester United. Perhaps Mr. Mourinho is not quite as special as he once was, but we'll see what happens there. So to finish with, and again, it's going back to my major theme about ensuring that you buy shares for the longer term and not worry too much about the shorter term. We're taking a comment from Jim Cramer, who is a well-known commentator on CNBC and a very successful hedge fund manager in his day. And one of these quotes, out of the thousands and thousands that are out there, is whatever money you may need for the next 5 years, please take it out of the stock market right now, this week. There we go. That plays into my philosophy. Like I say, obviously your pension, your longer term, your retirement monies needs to be in the stock market because that's where you're going to see the capital growth over time. But if you're looking for a short-term gain or a short-term loss, go to Vegas. All right, guys, enjoy the rest of your week, and anything you need, please get in touch. Cheers, bye.